let's talk about rates. What do you think about interest rates? And then maybe also the Fed's balance sheet. I know we were talking about that before we hit play. Do you think the Fed's balance sheet plays into potentially the stock market being at all-time highs with that liquidity component that we were referring to earlier, even if it's just Janet Yellen taking the TGA from 700 down to 200, therefore you got another 500 billion in bank reserves, or I think there's 500 in RRP. Maybe that goes into bank reserves. And the argument there, I don't buy it, but the argument would be there's more liquidity to pump up stock prices.
Well, I think that can definitely be true, right? Ironically, I actually put far less emphasis on the Fed's balance sheet than I do on kind of what caused it to get there, right? Or the components that contributed to it. Obviously, the buying of the securities was an important component of it, but far more important, and this is something I talked about, in a contemporaneous fashion. So in April of 2020, I was highlighting this underlying dynamic that, we lent money freely in the Paycheck Protection Program and told people, we'll pay for you to keep your workers, right? We'll pay for you to stay open so not everybody loses their jobs and then we're all trapped in a cycle of unemployment, et cetera. We basically bought people's jobs with the subsidies. That money doesn't go away simply because, when that money is lent, it theoretically goes away when you repay the loans. But if you then equitize the loans, as we did, we basically said, all right, we're going to forgive every PPP as long as at least one person smelled something that looks like a job somewhere along the way, right?
Right. Yep.
So when you wipe that out, now you've actually turned it into cash that's sloshing around in the economy. It's effectively a giant tax refund that was handed out there. And that money is going to circulate until it gets destroyed. Right? It has to get destroyed in one form or another. It can get destroyed through taxes, right? It can get destroyed through actual credit losses. And I think there's some interesting stuff that's developing there as we look at the overinvestment that may or may not be happening. We certainly are seeing it in commercial real estate. And this would just be like, just think about the dynamic. Imagine you're a wealthy real estate developer, fresh off your tour as president of the United States. You decide that you need to refinance one of your buildings. You go to refinance, and the appraisal comes back and says, yeah, I got bad news for you. This building is worth $150 million less than you thought it was worth, or the last time we financed it. And you've paid off no debt.
Yeah.
Right. So the only way that we're going to let you do a commercial real estate loan and maintain a similar level of leverage is by actually saying, you know what, we need to effectively adjust the price lower, right? We need additional security. And therefore, the appraisal comes in below what you would need. And in order to close that loan, you then have to show up with cash.
Yeah,
Well,
right.
that's actually a way that you're destroying cash. It's not like that cash that you pay to facilitate that refinancing is somehow or another making it out to the next player. It's actually literally just being burned, right?
Yeah. And just let me explain that for people, Mike.
Sure.
What we're talking about here, guys, is really it's just, are more loans being created on net or more loans being paid off?
Mhm.
That's all. That's the only thing you got to look at it. So if you got $100 million loan, well, they just created $100 million of additional M2. But if you refi that loan and now they say, well, we're only going to give you 50 million. Well, now all of a sudden you have to come up with the additional 50, you pay that off, and that decreases M2 money supply by $50 million.
Right. That's exactly right. So, the story of the huge growth in M2 money supply around COVID was tied to companies seeing the crisis emerge and immediately responding to that by saying, oh my gosh, we're going to take out as much money as we possibly can from our lines of credit, because we lived through this experience in 2008 where lines of credit got pulled. So we're going to act first, right? Before they can tell us we can't have the money, we're going to take the money legally, but we're going to take it. If you then have to use that money that you've taken out to preserve control of the assets, the other assets that you own. So, just say, for example, you own your home, you go to refinance that home, and the bank says, yeah, we can't let you do that because it's now trading at, 105% of loan to value, whereas before we were willing to refinance you at 80% of loan to value. So that means that 200, that 100, that 25%, I'm sorry, it's just gone, right? I mean, literally, it's the exact same thing as if you had to pay taxes, et cetera. People who spend a lot of time talking about this differentiate between the two. The government created money and the private sector created money. You know, what they typically refer to it as fiat money, or money that is created vertically by the government. And then the horizontal money creation is what's coming out of the banking system, that effectively is just a way of being flexible and expanding it in response to supply and demand.
Mm,
We just haven't had one of the, net supply periods in a very, very long time. That's really what it means when you see interest rates increase, is it saying there's less cash available to meet those needs. And a portion of that cash has to go to just preserving your optionality to hold this piece of real estate. And so I think one of the things that's so fascinating is everybody's very focused on this idea that there's all this cash that's out there. And then I look at a number of asset classes and I'm like, wow, they're going to be burning a lot of cash.
right. That's a very interesting angle, Mike. And I've never given that any thought. I always just look at the balance sheets involved in the mechanics. So as an example, if the Fed's buying from a non-bank through the primary dealer, it's going to increase M2. Or to your point, if you're drawing up a line of credit, there's more loans being extended by banks, that's going to increase M2. But then I ask myself, okay, is that just an asset swap? Because if you're an individual, a non-bank that has that treasury, it's a cash asset, cash equivalent. Mm-hmm. And if they're just replacing that with savings, that savings is most likely going to be very low velocity as well. So yes, even though M2 didn't increase, or it did increase, did it really matter? Because that money isn't circulating. Or if the government comes in, and let's say the Fed's not even involved, and they deficit, so Janet Yellen issues that treasury that is from a non-bank, so she takes that money out of M2, but then she recirculates it back into the economy. So on net, M2 is the same, but the economy has an additional asset in the form of a treasury, which you could add increases purchasing power. And I would argue increases velocity, because you're taking M2 that's effectively savings, zero velocity, and turning it into checking, which is much higher velocity, until eventually that goes back into savings. So, but it's just a different way of looking at the same thing.
Yeah, I mean, there's an element of moving across what's called high-powered versus lower-powered money, right? I'm fairly certain, though, that M2 actually does include checking accounts.
No, it absolutely does.
Okay.
Yeah, it absolutely does. I'm just saying that if if Janet Yellen is selling a treasury to a non-bank entity, most likely that's coming out of savings, which is M2. So that's going to reduce savings, but then it's going to go to the TGA. She's going to spend it right back out into the economy, which is going to bring M2 back up to the level where it started. But the difference there is that velocities change, because you've taken savings and basically turned it into checking.
Yes, I think that's fair. I think that's correct. And I again, when you see a government that is running this degree of deficits, and has accumulated debt to these levels, interest rates perversely actually become fiscal policy. And this is clear. I think we have a mutual friend in Warren Mosler, who I know is many people who are concerned about monetary policy will react to the idea of modern monetary theory, which Warren helped create and facilitate from a trading standpoint. They react to it with horror, right? You can't just print money into existence. That's not how money works. Well, unfortunately, that is exactly how money works.
Yeah.
Right. And what you're complaining about is how the money is being spent. And I think that's really critical. Like when you brought this up earlier, when you talked about energy, if we were to decide to spend government resources quintupling the quantity of electricity that is available in the United States and lowering the price on it, just literally writing it off in the same way they did with the PPP loans, right? Like, just remember what a PPP loan was. It was a gift to your neighbor, right? It was just, if you happen to be wealthy enough that you're employing and hiring people, and those people are going to lose their jobs, we're going to send you loans that allow you to continue to service the obligation you owe to your employees, right? Oh, and by the way, as long as you do this for a short period of time, you get to keep a large fraction of that yourself, somewhere in the neighborhood of 30% or so. Or you could use it to increase your 401k contributions. these types of dynamics are playing through, and candidly, I look at our monetary policy right now, and I know everyone is going to scream at the screen when I say this, but higher interest rates are actually reinforcing a higher inflationary environment. Right?
Yeah.
We're not building the facilities that we need to build. We're not changing our behaviors in a way that actually will solve a lot of these problems. But what we are doing in spades is we're basically saying, oh, well, let's increase the government's fiscal deficit by another 2 to 3% so that we can hike interest rates by another 2 to 3%. You're not actually controlling inflation there. That should be fairly straightforward and obvious. You're just giving more people to people who spend less of their incomes, the wealthy as compared to the lower income. But the other thing that is ultimately happening is that we're failing to invest in new capacity, right? Or at least lower than we otherwise would have. And so, we're still, like, I've still got a screen open to Taiwan and China, et cetera, to monitor how things are going in those countries, because we're not yet building it in the United States. We're slowly starting to, but it's going to be a long time in coming.